Welcome to Kitco News. I'm Niels Christensen. The gold market is attracting a lot of attention lately, but not all of it is for the right reasons. Conflict gold is an issue that keeps rising up. But here to talk about this topic is Michael Albanese, CEO of Tradewind Markets. Michael, thank you very much for joining us today. Thank you for being on the show.
It's great to be here again speaking with you.
So this is actually this is a very serious topic. Conflict gold. What are your thoughts on this? I mean, we're seeing a lot of people sort of take an interest in how gold is being produced. And I really want to get your thoughts on this because you actually have been a big advocate of ethical gold, and Tradewind Markets has been an advocate for ethical gold.
Absolutely. Thanks for the question. There is a lot going on in gold in general. There's a lot particularly going on in ethical gold. And happy to give my views on how I see this space evolving and what I think about the landscape in front of us right now. So as you said, you hear a lot more about this topic now than you did maybe a year ago. And despite some of the negative press that the concept of ethical gold has gotten, I actually think it's very positive that market participants, whether they are mining companies, whether they are banks, whether they are downstream purchasers of gold, are starting to become much more conscious and conscientious about understanding supply chain provenance. So where the gold came from, how it was produced, in some cases, whether it was recently recycled or not. And I like to think that the story develops according to a couple of different storylines. So you'll remember maybe 9 months or so ago, everyone would speak about ESG as though it were one kind of bucket, right? But I think the market has figured out that there is a distinct E, a distinct S, and a distinct G. So my view is that there are a lot of drivers, different drivers than the past, that are creating demand for understanding supply chain provenance. So let's take the E first, the ethical piece of it. Or the environment piece of it, excuse me. So on the environmental side, you do see some companies that are not waiting for regulations to be mandated. They're not waiting for the industry to agree on precisely what the environmental framework should be, but they're taking the proverbial bull by the horns and they're defining their own corporate best practices in accordance with some general guidelines. You see companies as recently as a couple of weeks ago talk about how they're going to be reducing their carbon footprint by sourcing metals from certain mining companies that are themselves responsible about how they use CO2 emissions, how much mercury they use, et cetera. So first is that E component. But it's not just about environmental, right? Because you also have an S component, which of course is social. So you see a lot more interest among institutional investors and even jewelry companies around understanding what kind of social benefit their investments bring. So is their purchase of gold going to mining companies or jurisdictions that pay a fair wage, that employ best practices in terms of labor, that are not involved in conflict metal, et cetera? That brings us, of course, to the G, governance standards. And I think we're probably going to see more active participation among investors in understanding what type of board of directors governance some producer companies have, whether there's diversity of opinion on the board, and all of that. So I think it's become much more than ESG as a bucket and much more about the E, the S, and the G. And then, of course, there's a fourth bucket as well. So some companies simply by regulation need to do a certain amount of diligence and reporting on their supply chains. A great example is here in the US. For the most part, if you are a listed company, you must report to the regulator, to the SEC, about how you source one of four different types of conflict products, gold being one of them. So in some cases, it is mandatory. What I think is even more interesting, though, about than the E, the S, and the G itself, is that it's starting to create a very interesting and serious dialogue about whether ESG goals are actually being achieved, because you have a great group of companies that want to achieve progress, but the question remains, are they achieving the progress? And maybe I'll give you two quick examples from the recycled gold side. So I often hear that if you buy recycled gold, then you'll make sure that there's no more irresponsible mining that occurs. But I think what is being called out is, think about that for a second. If there's more purchase of recycled gold, does that necessarily mean that there's going to be less mining? Or will mining continue? Because mining tends to be driven by investment interest in gold. So I think it's calling out the question, if you want to do something proactive, if you want to do something beneficial to the gold ecosystem and be more responsible, really question whether your actions are having the appropriate results. Another quick example is, living conditions. If you're the type of investor that wants to improve living conditions in a developing nation that produces gold, are you better off going recycled, or are you actually better off purchasing from that mine, maybe paying them a bit of a premium in order to see your investment trickle down and maybe have some social benefits? So, of course, I'm not advocating one or the other, but I think it's actually healthy that the market is starting to have this dialogue about whether the intended impact of the investment is materializing the way that they saw. But it's a very, very exciting time to be in the business.
Well, and I think it's evolving, and I think one of the issues that like when I cover sort of the conflict gold side of it, it seems really about the reporting. Like it's like the supply chain, the provenance of this, and I'm sort of wondering, Tradewind's Markets has developed this digital platform, and part of this is the provenance. I mean, is that the way we got to go? Do we have to go more digital in the gold space so we can really track where this comes from? Like from the mine to the refiner to the consumer. Is that sort of the future?
I think, of course, digital has a very active role to play. I'll also say that there are several different approaches that players in the market are taking. And maybe I can start just by reminding you what it is that I do for a living and what it is that my team does for a living. So, of course, at Tradewind, we are a financial technology company that has put together a product that makes it easier to purchase, to custody, and to invest in precious metals in a more cost-effective, in a simpler, in a more secure way. What we found is that by the benefits of ledger technology and some smart vaulting practices that we put together, specifically with the Government of Canada at the Royal Canadian Mint, there is a lot that investors can do to purchase metals in a more cost-effective, secure way. Now, our blockchain has the benefit of being the official legal records of title as endorsed and as recognized by the Government of Canada. So it adds that level of security, that level of auditability, that level of trust and credibility. So a natural next step for us was, how can we enhance those digital records of ownership to make it easier for purchasers to understand what they're actually buying, to help them deal with trusted sources, making sure that they only buy from mining companies they trust, or mining companies with good track records, or intermediaries with good track records. So by taking the best of the ledger and the blockchain technology and the digital records of ownership and linking them to data, information about when, where, and how the metal was produced, we thought that would be a very creative way of now, without waiting for a year, putting technology in the hands of purchasers and sellers so that they can get started with this concept of responsible sourcing. I would say, a couple of things come to mind when I talk about this solution. Yeah, we put this together as a very low-cost, immediate way of putting your principles in action. Whenever, and I've got some experience here from the securities markets, I worked in banking for the better part of 17 years, and I can tell you, whenever the industry drives change, and whenever an industry tries to improve best practices, there are a whole series of stakeholders' opinions to take into consideration. Producers, banks, investors, refiners. And industries like gold are faced with a choice. Do you wait for consensus? Do you wait for everybody to agree on every exact step along the path to adoption? Do you wait for the rules to be written? Or do you just get started with something, try it out, and then build on it as you go? Mm-hmm. We very much think that the right way to do this, which is why we've gone this route, is to put something into the market, get it into the hands of producers, get it into the hands of the precious metals ecosystem, and get feedback on it and really equip them with being able to make improvements now, as opposed to waiting for consensus. So what I am really encouraged by is that you have all of these proactive announcements by companies that source metal. They're not waiting for the market to be perfect. They're getting started with their own principles. They're getting started with basic technology so that they can start applying their ESG principles to their current portfolio. And it is amazing, I'll tell you, how many really good asset managers there are out there that have been investing in equities and bonds in an ESG compliant way for years. But if you ask them about how they're applying those ESG principles to the metals markets, they don't really have a good answer, because until now, there haven't been that many tools available to them. So I'm encouraged. I think it will take time. But what I like about the way the market is evolving is that there are smart technologies coming out now, including, but not only ours, and it's empowering people to put their money where their mouth is when it comes to making real investment decisions that make sense, that are in compliance with their own investing principles.
So what do you think it takes to get to the next level? I mean, does ethical gold need to be sort of its own commodity, I guess, with its own premium to the market? What's sort of the next level are you looking at?
Sure. I think, the question remains, will ethical gold command a premium or not? In my own personal thought process, it almost seems a little bit odd to say that if you want something ethical, you have to pay more. Someone might take the other side of that and say, you should pay more. But in my mind, if the industry is serious, the benchmark should be ethical gold. That should be the standard, as opposed to the premium, so to speak. So maybe a better way to phrase it is, would non-ethical gold command a discount, as opposed to will ethical gold create a premium? But look, practically speaking, I think as opposed to a year ago, the industry does have tools like Tradewinds that they can actually use to be selective about who they buy from. What I would love to see, and I've been vocal about this before and will continue to be vocal about it, is that we don't make perfect become the enemy of the good. We can gather 20 people from the industry. The gold industry is fantastic. It's got a lot of highly talented people, and we can sit in a room for 3 years, and I'm convinced we can design an excellent system that is nearly flawless. Not perfect, but nearly flawless. Do you need nearly flawless in order to get started? My response would be no. Start doing some basic screening. Our technology, for example, allows you to screen based on the mine of production, based on the geography of production, and based on the ethical standard that was employed. And in contrast to some other providers out there, we also have a level of third-party verification. So you're not just depending on that producer and taking him or her at their word, but you also have that refiner in the middle that's doing an additional level of reviewing, of screening, before anything gets written to the records. So look, if it were up to me, and hopefully I'll be able to convince the market of this as well, I would not let perfect be the enemy of good. I would not wait for all of these various standards to converge, and I would not wait for regulation to be imposed. I think it's much healthier for the market to come up with a solution itself. The good news is we do have a solution. It's basic, but let's get that into practice, and then we can build on it as we go. I think that is the healthiest next step for the market itself.
Just, this whole conversation about, ethical gold. Is this the conversation we should be having, when we're looking at prices at $1,900? It does seem like this is the time, investors are sort of watching the marketplace, and now it's time to, sort of educate them about, what's happening in the industry.
I think there are a lot of things. I would not stop at just ethical gold, but there are a lot of things that I think the time is incredibly ripe to be speaking about across the industry. And I tie this all back to, we were speaking just before this meeting about how many things have changed since late March of this year. And I feel like since the last time I spoke with you, it's been years and years, because almost years and years worth of change has happened in this industry since we last spoke around the March timeframe. And so when I look at what the dialogue, in my view, what the dialogue should be at the industry level, it is really about one overarching thing and then three sub things, which I'll go into. So one, how has the COVID-19 crisis in unexpected ways actually exposed some shortcomings in the way that the gold market operates? They're not impossible to fix by any stretch of the imagination, but it has exposed some shortcomings. So the first shortcoming, and this is near and dear to my heart because I spent some time in other markets outside of gold trying to fix some of these problems on the security side. Number one is, I think COVID-19 highlighted how overdependent the industry is on physical movement, physical shipments of gold in specific formats, in specific weights, in order to settle certain trades. And this became acute in late March. And you probably remember there was a point in late March where there was a huge premium to be commanded for gold in a New York vault as opposed to a local London piece of physical gold. Usually those markets trade fairly tightly. But because there was a shortage of supply, because COVID-19 had impacted the ability of refiners to refine at the pace they were used to, because COVID-19 had reduced the amount of flights that were flying, not just transatlantic, but also transpacific, it created shortages. So there were big premiums and dislocations in price for New York gold. When I look at the, another example of that same thing, when I look at the June settlement on the CME, I think it was something close to 170 tons actually settled physically into New York vaults in June. That's multiples of what usually happens, right? So I think it exposed a shortcoming. And there has got to be a better way for the gold market to settle gold transactions than physically shipping bars in certain formats and getting them into vaults in downtown New York. So that's number one. It caused a bit of a dislocation in price, which was unnecessary in my view. So that's one. Number two, I think COVID-19 also created demand among investors, and some of them are retail, some of them are high net worth, some of them are even retirement account investors that are looking at their retirement futures. Some of them are institutional asset managers. And it created a demand for an asset that is a bit countercyclical, a bit less correlated with equity markets and bond markets. All well and good. For the past couple of months, I think gold has been playing that diversification role. But right after the COVID-19 crisis got started, I hate to admit it, but gold was actually not playing that diversification role. It was actually moving in tandem for a few days with stocks, with investment grade bonds, with treasuries. And part of the reason I think for that is as gold prices dropped, a lot of funds needed to sell gold. A lot of funds that invested in gold needed to sell it in order to raise money for margin calls or to meet redemption requests from some of their shareholders, only to have to buy that same gold back again a week later when demand went up. So you had these huge swings in price for gold, which kind of broke the pattern of gold being a countercyclical asset because it was moving in the same direction as stocks. Wouldn't it have been better if gold could have been used as a collateral asset from those funds rather than selling it outright and changing price and swinging price? Could that gold have been pledged for a 10-day liquidity facility or a 10-day loan? And my view is, why not? Because it happens in securities markets all the time. Imagine if that gold could have been tagged with supply chain provenance information, so the lender of money knows the type of gold he or she is lending against. Imagine if you were able to allow those funds 10 days of liquidity so they didn't have to dump the gold. I think gold would have played its role a lot more elegantly earlier on in the crisis. So those are the things that come to mind when I think about what's next for the gold market and what COVID-19 exposed as some shortcomings, but highly manageable shortcomings, because all of those problems I described can be creatively solved through a combination of smart technology, smart policy making, and smart risk management.
Thank you very much for your comments today.
I appreciate the dialogue. It's my pleasure.
Thank you very much for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.